What's up, world? This is Serge DeHady with Serge W. DeHady, CPA PLLC, where life is good, living is better, and I'm the dreaded CPA. I made two videos off of TikTok going into trust estates and transfer taxes. So today I wanted to get a little professional with the presentation. So I hope you get a lot of information from this and also that you enjoy it. So, like I was saying in the previous videos, estates and trusts, they're taxed on the income, but not on the principal that is put into the trust or the estate. And when they finally transfer to the beneficiaries, that's when they actually are taxed, which is the transfer taxes or estate taxes or death taxes. Something that Joe Biden is looking to get into to raise revenues for giving out all this money in the past for the stimulus. So a tax is hit on the income that's generated from trust and estates, but not on the items that is treated as principal. And in the next slide, I'm going to get into the principal and the interest. Every state has the authority to define what is considered principal and interest for federal tax purposes. And every state has adopted the revised Uniform Principal and Income Act, which is basically a standard for saying what could be considered a principal and interest for trust and estates. Since I'm in Florida, the Florida state statute that defines principal and interest is Chapter 738, and the principal is ultimately delivered to the beneficiaries at the death of the person or determination of the trust. And the legal term for the principal is res or corpus. So right here we get into what is considered principal and income. And these are the receipts, which is actually what goes into the trust or the estate. Yeah, give me a second. This music about to switch over a little bit. Got to get coordinated. Yeah. So the principal that you put into the trust or the estate are consideration for property that's gains on sales, replacement property, non-taxable stock dividends, stock splits, stock rights, liquidating dividends, and royalties, the contracts. And the income is the business income from these assets, the insurance proceeds from the loss of profits, interest, rent income, dividends, extraordinary dividends, taxable stock dividends, and royalties income. Yeah. So the disbursement of the principal and income is gonna be taxed or used in the calculation to determine the taxable income for the trust or the estate. And to reduce the income from the estates of the trust, you got the principal debt payments. Whenever you have a loan, the payments that you make towards the down payment of the loan is considered the principal payments. Capital expenditures, they could be major repairs or modifications. And fiduciary fees to maintain the trust or the estate, and taxes on the gains on the sale of the items that you have. And on the income, what reduces the income from the trust of the estates are the business expense, production of income expenses such as maintenance, insurance, rent collection fees, and even paying me, the certified public accountant, taxes due on the fiduciary income and depreciation expenses. And this is just a little brief review of how to calculate the income on the trust or the estates and what separates the principal and the income. Ultimately, depending on what state you're in, you want to check with your state statutes to determine what your state considers principal interest for tax purposes, federal income tax purposes. And again, I'm going to close out saying, life is good, living is better. This is Serge D. Haiti as a dreaded CPA. Peace.